Good morning, everybody, and welcome to our second quarter edition of our webinar. Sorry for kicking off a little bit late, just having a couple of technology glitches. So Claire will join us when she can. So the theme of this quarter's webinar is trade wars, growth, and who can spot the $1.2 trillion elephant in the room. So if anybody wants to venture a guess, you can try in the comment section, but we're going to get there. We're going to get there soon enough. So if we're going to start off the presentation, I think there's been a lot of geopolitical risk and a lot of headlines which have been driving market performance over the last quarter. Some of it have been positive headlines, some of it have been negative headlines, but I think the high-level summary of it is that all of it has been very negative for financial markets, whether it's locally or internationally. If we look at some of the big ones that there's been obviously the major one, which has been China's trade war, or the US's trade war spat with China, and the implications that may have on global growth through the impact on global trade. If the world's two largest economies are going to impact, are going to have an impact on each other with regards to putting on trade tariffs, what impact is that going to have not only between these two countries, but also the rest of the countries in the world in terms of how they conduct trade, and what impact is that going to have on economic growth, where expectations were very, very bullish coming into the year. Actions taken by, for example, the US in terms of stimulating the economy by cutting taxes, corporate taxes, has continued to maintain the positive backdrop for growth to continue. But the world is really concerned about what is going to be the impact of this war between the US and China with regards to trade. There's also been the Federal Reserve has been definitively changing its tone from becoming more dovish to more hawkish. And that's created a lot of concern around volatility, particularly leading into the months of February and March. A lot of volatility with regards to what the outlook or what the impact on financial assets might be as a result of higher interest rates faster than expected. And we'll chat, in fact, a little bit about that later on in the webinar. Some of the other things which have been making headlines more recently has obviously been the Cambridge Analytica scandal, the leak of 87 million people's data to Facebook, and how that was used to influence people's opinions with regards to voting around at the US election. And we've seen Mark Zuckerberg actually testifying in front of Congress a couple of days ago in terms of how Facebook runs their business. And there's been a lot of interest in terms of what that might mean for regulation for tech going forward, and why the market is nervous about that. Obviously, there's been the impact of Naspers and Tencent. We saw Naspers selling down 2% of its Tencent stake. And as we reported back in the last quarterly, given that Naspers generated around 60% of total JSE performance last year, the fact that we've got this impact of a selling down in the proverbial goose that laid the golden egg, there's obviously been a lot of question marks in terms of how Naspers will, one, deploy that capital, and whether it will be through a profitable means and will continue to drive strong share price performance. We've obviously seen the share coming under a bit of pressure. On the local front, the political news has broadly been very, very positive. We see Cyril Ramaphosa really hitting the ground running. We've seen a shaking up of boards at state-owned enterprises, trying to root out corruption there. We've seen him talking the right language in terms of instilling business confidence and getting investment going in South Africa. We saw him at the Commonwealth Summit this week in the UK, where he secured a small amount of investment from the UK, but really going on a drive to secure $100 billion investment in foreign direct investment over the course of the next 5 years, and really rolling out the dream team to do that. If you look at former Deputy Finance Minister BC Jonas, which is an exceptionally bright individual, you have Jaco Marie, Trevor Manuel, so a number of big hitting individuals on that panel in terms of trying to secure investment for South Africa. The unfortunate reality is that all the positive political developments has resulted in a very, very strong rand, and that has obviously weighed on local equity performance, obviously, given the extent of rand hedge earning some 75% of the top 40 index being rand hedged, but also just weighing on the contribution to total performance from a balanced portfolio, utilizing, for example, a 25% offshore allocation. And we'll chat around some of our ideas there. I think first and foremost, we've obviously seen South African bonds have done exceptionally well over the course of the last 5 months or so, in lieu of the very much positive political picture which has been painted, also an improved economic picture. And one of the core reasons for that is that, the market is expecting South African debt to consolidate from the very disastrous trajectory we were on at the 2017 medium-term budget policy statement in October of last year. If we look at the 2018 budget, a lot brighter picture, the picture painted in terms of consolidating that debt, an actual plan in terms of what's going to be done to raise revenue in order to consolidate that debt, some cuts in expenditure, some of it disappointing, which we'll chat about a little bit later. But ultimately, the fiscal path of South Africa is one of which is a lot more stable than that communicated at the medium-term budget policy statement, and that's really what we see in this graph. Still not as good as what was communicated in the 2017 budget, but one has to note that there is additional funding pressures which have been added. So if one thinks of 57 billion rand, which needs to be allocated for free higher education, that's just the obvious one. Further relief for drought-stricken areas like the Western and Eastern Cape and the impact of the drought on there, and further funds needed there, obviously weighing on additional funding needed. So all in all, the market is giving a significant amount of credibility to the Treasury for a very, very difficult budget that they had to present in 2018. Obviously, hiking taxes the year before an election wasn't a very popular decision, but ultimately had to be taken in order to raise that additional 23 billion rand, given the extent of our ballooning debts in South Africa. If we just look at our budget deficit, just a different way of essentially representing exactly the same thing, but the budget deficit is on a path of consolidating a lot faster than what was communicated at the medium-term budget policy statement, should I say. And the ratings agencies ultimately really like that. If we look at the forecast for economic growth, one looks at the actual number that came out for 2017, 3.2% growth in the fourth quarter, translating into 1.3% growth for the entire year of 2017, well ahead of the 1% growth that was being forecast earlier on in the year. If one looks at inflation moderating a lot more aggressively, the current account improving as a balance of GDP, all these factors are very, very positive for the medium and long-term outlook for South Africa, both in terms of growth and in terms of debt consolidation. I think that's really what steered the ratings agencies to take the decisions that they have. Earlier on in March, we saw Moody's coming out with a decision to really keep South Africa's debt on investment grade. That prevented $10 billion worth of outflows, and more importantly, upgrade South Africa's outlook to stable from negative. And that means that what Moody's is saying is ultimately they don't expect a downgrade for South Africa over the course of the next 2 years, which is obviously very, very positive, given that they still have us on investment grade and still keeping us in that all-important Citibank World Government Bond Index. So this has been positive developments. If you look at S&P, they've been one of the three major rating agencies which have been the most negative on South Africa over the course of the last 2 or 3 years or so. They're coming out with a ratings update on 25th of May, but anecdotally, they've doubled the expectation of growth for South Africa in 2018 from 1% to 2% on the back of greater policy certainty, should I say, and improved investment. And we expect them to follow suit in terms of not necessarily upgrading South Africa just yet. It's still far too early for that, but in terms of taking us off negative watch. And that's obviously been very, very positive for our fixed income markets. On the negative side, however, if we look at what's happened with the budget, one of the things that stick out like a sore thumb is the amount South Africa spends on public sector wages relative to some of the other countries in the world. So at over 35% of our total budget being allocated to public sector wages, and if you think about another 10% being allocated to purely interest payments on debt outstanding, the size and the scope of the problem of the very tightrope National Treasury is walking is clearly put into perspective. Now, I think one of the disappointing things of the 2018 budget and of the outlook thereof is that 10 billion, or rather 85 billion rand in spending cuts was announced, but public sector wages were not touched at all. Now, if you put that into context, given that we spend such a large proportion of our budget on public sector wages, we would have expected that this could have been tackled a bit more aggressively instead of infrastructure expending, which ultimately over the long term is very constructive for economic growth. We thought that public sector wages might have been one area where South Africa could have found a bit of additional funding. So that's been disappointing on that front. But if you look at the scope of the inequality in South Africa, and traditionally government really viewing the public sector as a means of creating an emerging middle class which can stimulate the economy, it's put into context why the reason as to why South Africa has such a high public sector wage bill. Not that it's justifiable, because into the medium term we've got to balance expenditure with growth and tackling inequality in a sustainable way. And if you look at it, really, the top two quartiles of income earners in South Africa account for in excess of 87% of total household assets. I mean, that is a staggering number. And obviously, over the long term, having this extent of inequality in South Africa is just as unsustainable as having a very high public sector wage bill. So if you consider it from that angle, there's some sort of understanding as to how we've ended up in this scenario. But I suppose the ultimate resolution of this is that there's got to be some sort of constructive balance between addressing inequality in South Africa. We all know the findings of famous French economist Thomas Piketty and what happens when the return on assets outperforms the return on growth, and the wealthy ultimately benefit from that because of their how concentrated they are in financial assets relative to the bottom quintiles of earnings. Those are very detrimental to growth in the long term, because ultimately what happens is that labor has no longer an incentive to provide its labor input relative to capital input, and that obviously impacts growth into the medium term. So I think ultimately what's going to happen is that there's got to be a fine balance. We have to consolidate ballooning government debts in order to spur investor confidence, prevent further ratings downgrades. But at the same time, we have to deal with the inequality in the South African economy. And I think Cyril Ramaphosa is really doing a fairly fine job of trying to strike that balance. We see him talking about land reform and remaining adamant on the issue. These are really critical issues which South Africa as a democracy has to address if we're really going to tackle our long-term structural debt issues. If we just move on from this, if we look at so how is all this macroeconomic news filtered through into market performance? Because that's ultimately what matters. That's ultimately what matters to investors. And if we really look at it over the year-to-date period, over a 3-month period, every single subsector on the JSE has delivered a negative return. I mean, that's a staggering number. Despite all this positivity we're seeing on the political front, a very strong rand coupled with volatility or increased volatility from global sources has resulted in equity valuations compressing quite aggressively. And we'll chat a little bit about that recently. We think for the long-term investor that actually offers quite a bit of opportunity, and we'll justify why we think that's the case in a bit. But for the short-term investor, rand strength coupled with the volatility we've seen in risk assets has really resulted in quite a disappointing first quarter of the year. Relative to peers, we've obviously stacked up a lot more favorably, but in absolute terms, it's been fairly disappointing from that standpoint. And if you think about the rand and the impact it's had on the financial markets, the rand, as Cyril Ramaphosa has called it in a Bloomberg interview and in much of the investor roadshows he's been doing in the UK this week, it's really a double-edged sword. The stronger rand obviously shows the confidence or improved confidence of the global investment markets in South Africa, and But at the same time, a strong rand does definitely weigh on the export markets in South Africa, and the ability of South African exporters to remain competitive. And we see that most obviously, first of all, in financial market performance, given that 75% of the top 40 index is rand hedged. But second of all, if you look at it in terms of the terms of trade, and the terms of trade is really what is the total rand value of import, or of export rather, less the total rand value of imports. And when that number is declining, obviously total rand value of imports is increasing at a more aggressive rate than that of exports. And that's really the pattern we've seen evolving since the beginning of the year, as the rand has been going through exceptional strength. So there may be very early signs of our manufacturing sector feeling the pinch of a stronger rand, and more immediately, your clients and our clients on this call who have money with us in our portfolios have obviously felt the impact of that on their portfolio balances in terms of how equity markets and risk assets have performed. So if we look at just in terms of what has the strong rand, while composite market performance has actually been quite disappointing, there has been segments of the JSE which have performed quite well. If you think about the SA Inc component of the market, so basically the businesses listed on the JSE that are most exposed to the fate of the South African economy. You look at mid-cap businesses, you look at some of those which we've broken down in this chart, which is on your screen. Some of those retail businesses, if you think about Massmart and the extent to which that has re-rated, and then obviously the banks, which is the most obvious example in addition to the retailers. There's been a big re-rating in a lot of these retail stocks. There's been somewhat of a re-rating in the banking stocks, obviously different depending on which banking stock you're talking about. And the mid caps have been pretty flat. So our argument is, a lot of the questions which the market is asking is there still value left given the significant rally that we've seen in this SA Inc component of the market? And our answer to that would be, it's really selective. There's value in certain parts, so we certainly think there's a lot of value in the mid-cap component of the market. Even though Clover has done very well, we think that that's an attractive story. Rhodes Foods Group, which has disappointed so far, we think that's a long-term good story. Italtile, that's a fantastic story. Some of the other mid-cap stocks in there, if one thinks of Hudeco, Altron, those are really, really good stories. And we think that over the long term, these are a basket of stocks which can unlock quite a lot of opportunity from an improving South African economy, but also not solely dependent on that improving SA economy. They've already, started unlocking and investing for growth. And we saw that in some of these companies' recent results announcements. If one thinks of Italtile, continuing to invest for growth. If one thinks of AECI, made a number of acquisitions trying to grow. That stock has done quite nicely. And Hudeco, obviously very exposed to the South African industrial and mining sector. And that, with those outlooks looking a lot brighter, expecting better earnings there, and hopefully a re-rating from those shares compared to, say, a Massmart, which is already pricing in a lot of optimism. If you think about, at one point their share price in excess of 50% higher than it was prior to the ANC elective conference, before derating a little bit towards the back end of March, but ultimately still up over around 40-45% since the ANC, or since the beginning of December. And if you looked at the trading update the other day, we actually saw revenues declining because of negative inflation, but ultimately volume still remaining flat. Now, a business that has re-rated 50%, one questions whether in an environment where they're delivering flat revenues, whether that re-rating of 50% can ultimately be justified. And the re-rating has been, I just use Massmart as an example because the re-rating there has been very extreme, given the extent to which it lagged over the previous 5 years. But the re-rating has been quite severe across the entire retail sector. So if you look at, for example, the general retail index, which we plot over here, is still in the region of about 20% higher since the end of December. If we look at the banking sector in a little bit more detail, and that's the slide which is up on your screen right now. Yes, the banking sector has re-rated quite aggressively relative to the rest of the market. But ultimately, they still trade at a discount relative to the rest of the all share index. Still trade at a significant discount relative to the industrial index. And if we look at it, then we really have a scenario where we have businesses which are facing improving growth prospects. If you look at the recent results announcements from the banks, from Standard Bank to First Rand to Barclays, I think that from across the board, the theme that can be taken is that they have better quality of earnings growth. The non-performing loans are shrinking considerably, but more importantly than the non-performing loans shrinking, because that's not a repeatable and a sustainable source of earnings growth, they're talking about growing their loan book, and I think that's very important. If you look at someone like Standard Bank, they managed to grow profits by 18% at their last results announcements. We think that that's reasonable ground for multiple unwind over a period, still trading at a 5% dividend yield, with very attractive Africa optionality, and ultimately now very focused on their home markets and Africa, having disinvested all their international operations. So, and if you look at Barclays, I mean, that business still continues to trade on very lowly multiples. So while the overall banking sector might have re-rated quite aggressively relative to the rest of the markets, if we look at components of the banking sector, particularly Barclays Group, the performance there is actually still, despite a 10% re-rating of the stock, we're still talking about PE multiples under 10 times forward earnings, dividend yields of around 7%, very, very low expectations for growth coming from the stock. And with them looking to change strategy, increase their proportion of Africa revenues to 12% of Africa revenues over the medium to long term, we think that the market is excessively negative. Yes, they've made some strategic missteps over the last couple of years, but the 30% discount that they trade to relative to a Standard Bank, for example, that 30% discount certainly isn't warranted, despite the missteps that they've made. So some value unlocked to come through from Barclays Group as they grow their loan book, as they grow their top line growth, as they continue to pay out attractive dividends. We think that there's still a strong case for multiple re-rating to happen there. So, if we really were to summarize our view on South African, the SA Inc. component of the market, given what's happened in the markets in the first quarter, and we'll really wrap up with a slide. A lot of the optimism has really been driven by this slide. We're starting to see stabilizing and improving consumer confidence. We await the March consumer confidence numbers coming out shortly, and we expect to see a drastic improvement over there. But ultimately, consumer confidence has already started to marginally increase. We've seen retail sales which have drastically increased over the course of the last 2 quarters or so, well in excess of their historic trend over the last 10 years or so, but also just improving from very depressed levels in the middle of 2017. So, the market's starting to price in better conditions for retailers, better conditions for SA Inc. stock on the back of this improving consumer confidence and retail sales. And it's played out in various sectors in different ways. We would argue that in the retail sector, for example, this story has overshot itself. And this chart will show that retail stocks are trading very expensively relative to their history. And this has potentially overshot and overdone itself in that sector. But there's other sectors, for example, if we look at the mid-cap sector of the market, and if we look at the banking sector of the market, selectively in things like Barclays Group Africa, for example, trading at a big discount, we think that this theme still has to very much play itself out over a long period of time. And what we've really summarized in this final slide, which is where we'll wrap up before we get on to some other issues, is that what we've wrapped up on the slide is that, while the mid-cap sector hasn't really moved in composite all that much, there's been individual stocks which have moved, then it's if we consider it from that perspective, Clover up over 40%, AECI has re-rated quite nicely, but really speaking, there hasn't been a broad unlock of value from the sector. a broad unlock of value from the sector. And what we think is that that's really going to be a longer term story. And this chart really summarizes what that happens. We have a stable policy environment today. Unfortunately, that doesn't translate into earnings immediately. Although some of those mid-cap names like Italtile, like AECI, like Clover, for example, a recovery in earnings that has started to come through. But it's really a long-term story because these mid-cap companies now feel more confident about investing in their businesses, but ultimately that takes a while to filter through into earnings. What then happens is, subsequent to this investment, we start to see these companies' improvements in earnings, and as these companies improve in earnings, we initially see the market reaction to that, and share prices trend higher in reaction to the higher earnings. And what happens is that if this higher earnings is sustained over a number of reporting periods, we start to see the market saying, well, this is no longer a 9 or 10 or 11 times forward earnings business. This is actually a 15 times earnings business because they're delivering good prospects. And we get the second leg of the share prices doing quite well, where we see a re-rating in the stock. Then finally, and the final step of the story, and this is really a cycle which plays out over anything from a 12 to a 36 month or 12 to a 3 year period, a 12 month to a 3 year period. The final step of this is that you see a maturation of some of these investments where they start to generate phenomenal amounts of free cash flow, and these companies start to pay back dividends if they're wise. Instead of reinvesting it into other poor operations, they start to pay back dividends, and this dividends is what ultimately sustains total returns to shareholders from these mid-cap businesses. And this is really a theme which we think still has to play out in the market for some time to come. Overall, if we were to think of the JSE, remember that it's not just about the SA Inc. components of the market. There is obviously the Rand hedges. In previous quarters, we've chatted extensively about Naspers, for example. We've chatted extensively about how we think some of the Rand hedges are potentially overvalued. That picture has obviously changed quite a bit to the end of the first quarter, given the extent to which some of those companies have derated. If one thinks about British American Tobacco, for example, the stock is down 35% over the course of the last 4 months. If we look at the reaction to Philip Morris International's earnings releases yesterday, where they reported a 5.3% volume decline over that period, over the reporting period, and a slowdown in their revenue growth, or rather their growth from their e-cigarette business, the heat not burn, as well as the vapor businesses. The market reacting very negatively to a slowdown in that business, even though volumes have doubled over the course of 1 year. Since the December quarter, volumes in that heat not burn and alternative technologies at Philip Morris International, which is the leader in that business, has really declined over the last quarter. And the markets, the sell-off being pervasive, not only in Philip Morris International, but across all tobacco stocks. We saw Altria, Japan Tobacco, and obviously most relevant to investors on this call, we saw British American Tobacco coming in a severe strain yesterday. Our outlook, on the Rand hedge counters, particularly, or rather British American Tobacco in particular, is that the derating has been too severe. There's a lot of negativity being pricing in terms of top line growth and the alternate technologies, and we think that it's been excessively done. So there is selective opportunity in the Rand hedges, particularly in British American Tobacco, which we now finding, and I think that's quite an interesting opportunity. And ultimately, what this graph shows is that the overall earnings yield on the JSE has improved. Given the derating, we've seen select opportunities in the Rand hedges, one thinks of British American Tobacco, and continued opportunity in the SA Inc. part of the market, banks and mid-caps. We continue to see the earnings outlook improving as business confidence improves. And as a result of that, despite a very disappointing first quarter, into the medium to long term, we still remain quite constructive on the SA equity market. We are cognizant, of course, that there are going to be bouts of volatility filtering through from international news. And as a result of that, we may not necessarily be massively overweight in our balanced fund portfolios, because we look for attractive entry points as volatility plays through the market and volatility increases from a low base. But structurally, we're not all that concerned about the underlying prospects in equity markets. I think one of the things we decided to talk about, given the extent of the derating in the sector, is the listed property market. The derating has been exceptionally severe and has been very, very swift. And if we consider the earnings yield of the businesses, if the earnings yield of these businesses relative to what equivalent government bonds are doing, what we see is that for the first time in pretty much 3 years, we're seeing the listed property market on a forward earnings yield basis trading at a discount relative to the equivalent 10-year bond. The 10-year bond has retraced probably 100 to 120 basis points over the course of the last 4 months, and obviously listed property has derated significantly, which is what's been contributing to this. So it has piqued some of our interest, and ultimately, but it has taken a very volatile event in the form of what's happened in the Resilient group of companies to trigger this. Ultimately, what the accusations are is a complicated set of cross holdings between these 4 companies in the Resilient group of companies. And if you were to simplify it without reading through all the text on the slide, what it basically is they accused of using loan extensions to staff, as well as various trusts in the company, educational trusts, to buy up shares in these various cross holdings. So, for example, Resilient holds holdings in Fortress, it holds holdings in Nepi, it holds holdings in Green Bay, and those companies in return, some of them hold a holding in Resilient. So if the underlying NAV, if the underlying value of some of these listed businesses are boosted, clearly the companies at the top of that structure receive a boost in their underlying price. And this is what the argument is of, for example, some of the asset managers in the industry has been that they are using these share structures to basically boost the underlying NAV through buying shares in these underlying companies and thus boosting the price. So, as this uncovered, fear obviously remains heightened because of the Steinhoff scandal, because of the Capitec and the Viceroy reports that are circling the markets, although, one questions some of those and the validity of one of those, given Capitec's earnings numbers that they delivered, where they put a large number of those concerns to bed, although not in the opinion of Viceroy. I think that this has really been what's been the catalyst to unlock a lot of the value in this property sector, and something that we're looking at quite closely, given the extent to the attractive forward yields in the sector. In terms of the bond market, it's really been about the foreign flows. The foreign flows is really what's driven our foreign markets, and this is what's been the story of the foreign flows. It's been about attractive yield differential relative to developed markets. In our view, that we now are in expensive territory relative to our other emerging market peers, where they can where foreigners can gain access to this yield pickup, and at the same time, we've seen the US 10-year treasuries re-rate quite a bit, and at the we've seen that the bond market has obviously priced in a lot of this optimism of the improving South African macroeconomic story. And as a result of that, there's obviously quite a lot of risk to long-dated bonds in South Africa, because the yields have compressed quite a lot, and the funding risk still remains there. So it's really our view that given the extent to which the developed market bond market the developed market bonds have yields have spiked, and the extent to which ours have compressed, that it's arguable that too much positivity is being priced in, and the funding risk still remains a big concern, which over the medium term will place upward pressure on our bond yields. And I think given the extent to which duration has increased on the all bond index, for example, trying to chase that duration and going longer and longer seems the imprudent thing to do, especially given the extent to which this market has rallied. So yes, we acknowledge that there is a significant amount of improved macroeconomic prospects for South Africa, but we think that's more than priced in, and the market is not cognizant of the funding risks. And I think the time they will become cognizant of the funding risks is as developed market interest rates go up, and as foreigners stop looking for yield and blindly allocating money to emerging markets, or allocating money to other emerging markets, which quite frankly offer more opportunity than South Africa now. And as the market comes to that realization of the funding risk, we think that our bonds could come under some short-term pressure, and we'll certainly look for more attractive entry points into the market than under 8% on the 10-year bond. If we now move our attention to the international outlook, there's obviously been a lot of noise with regards to the impact of Trump, with regards to the impact of trade wars, on global growth, and ultimately, if global growth slows, investment slows, and if investment slows, earnings growth slows. We certainly haven't seen any evidence of that being the case just yet. If you look at the earnings revision ratio, which is basically just the number of company earnings expectations which are being revised upwards relative to downwards. So basically, when this ratio is above 1, more companies are getting upward revisions. We're seeing an aggressive improving earnings expectation in the US, and that's been followed up with the numbers. If anybody's been following the first quarter earnings season within the US, JP Morgan delivering $8.7 billion in profitability. And that's ultimately been their best quarter ever in the history of them being a bank in terms of quarterly numbers and quarterly profitability. So, and that's just anecdotal, but ultimately across the board, the earnings numbers seem to be good. And across the board, we're seeing companies continue to invest for growth. If we take very anecdotally, again, companies like Nestle starting to selling off their chocolate business in the US because that's not a source of growth. And the market really punishing Nestle over the last couple of months because they thought not to be a growth stock, and starting to redeploy some capital into R&D on chocolate which has less sugar, a Milky Bar with 30% less sugar. And the source of that is really the company is realizing that unless they deliver earnings growth in this environment, they are going to be punished by the market. They are going to witness a significant derating, and as a result of that, we're going to see a continuing drive for earnings growth in global equities, and we are very, very encouraged by that. So the underlying fundamentals remain solid. Investment is there, earnings growth is there, and we continue to look out for that. And at the same time, while there's investment and earnings growth coming through, the very sharp sell-off we've seen in the first quarter of this year has ultimately meant that on average the S&P 500 actually trades in line with its long-term average multiple compared to, say, its 30-year or so history. So you're paying average multiple for far superior earnings prospects from these companies, and we remain very encouraged by that. So while there is, yes, some macroeconomic noise and some political noise which is going to affect valuation in the short term, we think that for the long-term investor, offshore equities continue to offer an attractive opportunity. If we were to look at what's been the source of, a lot of this increased volatility, particularly in the first quarter of 2018, if we look at what's been the source of it, it's really been the expectation that interest rates in the developed markets are going to increase at a much more rapid rate than what they have been over the last couple of years. And if you look at, what the market, and what this chart basically shows is what the market expectations for interest rates have been relative to what the Fed dot plots have been indicating. And what the graph immediately shows is that for the last 3 years or so, the market has given very little credibility to the Fed in terms of reaching their indicated path of increased interest rates. Something that's changed in 2018, and I think we can say that with a fair amount of confidence. The market has all of a sudden started to take the Fed at their word with regards to the communicated path for interest rates, and what that ultimately means is that you have a scenario where if the market is now taking the Fed at their word, increased interest rates will ultimately mean that we're going to have a scenario where the discount rate is increasing, and that's what's really been the source of a lot of volatility. The market now starting to price in the reality that interest rates could go up 3 and possibly even 4 times in 2018, and what impact is that going to have on risk assets? If we put this volatility increase into perspective, I think Claire is finally on the line, so I'm going to let her chat through this. Claire, are you there?
Yes, sorry about that.
We can hear you loud and clear.
Okay, great. So I think what really the heightened volatility has meant is that no more is the market being driven by one overarching fundamental macro view, but it's really become more of a stock pickers market, and as people are discounting and expecting that the global environment and specifically interest rate policy is going to start returning to normal, what we see is that fundamentals begin to matter more. And as a result, we move into an environment which is much more of a stock pickers market, and then we return to the increased levels of volatility. But really, you know, that the market has gone throughout its life, gone through different cycles of volatility, and this is what the slide shows is that, you know, as you move into interest rate increasing environment, so volatility comes through into the equity market. And typically, increasing volatility coupled with normalizing interest rate policy and increasing interest rates are good for the equity market, and that's what can be seen here. You know, the extent to which companies are able to pass through inflation to their consumers allows them to push on the higher prices and to actually expand their margins into a period of increasing inflation and increasing interest rates. So, you know, equities have been a huge beneficiary of expectations of inflation, in terms of benefiting from what consumers expect and what the reality is at the point in time. And in the US, additionally, the macro tailwinds remain fairly strong for equity markets as well, and this really shows the impact of what the US policymakers do in terms of bringing growth through into the economy, and for now the levers for growth are still there. The regime is pro-growth, and we've seen that you know, policy action has had a very real impact on economic growth, and that's still likely to come through into the future.
So, I mean, if I can just add to that, sorry, Claire, if we can just go back one slide. I mean, if we think about the impact of the US tax cuts, I mean, in 2018, that's going to add 1% to US economic growth. You know, that's a staggering number. So the market is becoming increasingly bearish about the prospects of a trade war with China, where, you know, the outcome is not even known as yet because nothing has been officially put in place, versus concrete measures which are measurable in terms of the impact on growth. I think those will largely be offset, and the trade war fears will settle down. So I think that the outlook from a tailwind perspective still remains quite strong. And I think the other interesting thing to note is that what this chart basically shows is the impact of US fiscal. So the times where the chart is negative is basically where there's been contracting fiscal stimulus, so basically austerity. And the places where the chart is positive is basically where there's been fiscal stimulus in terms of either spending or tax cuts. And the interesting thing is that the recent period of fiscal stimulus, which we're seeing, is the first time that we're seeing a stimulus from the US outside of a recessionary environment. Now, that's actually quite astounding if you think about it. And so the economy is already not in a recession, yet the US government is deciding to stimulate the economy through further fiscal measures. There's obviously some concerns about the long-term impacts of this on the economy, but we certainly still see some slack in the economy given the advances in technology and a lot of pent-up demand as a result of that. So we don't see it being overbearing on inflation. And I think this is just some of the underlying strong fundamentals, which is resulting in increased increased investment and improved prospects for listed company earnings. If we move on to the next chart, and Claire, I'm going to let you chip in here where necessary. But basically, there's been a lot of talk in the market recently about the more regulation coming to tech. Obviously, the Cambridge Analytica scandal has just really been a catalyst to unlock the pace at which that might be happening. But there has been calls from society for this to happen for a long time. If we think about, across the Atlantic from the US all the way to China, in China, there's actually a lot more intervention and a lot more regulation of these tech companies. In fact, to the extent of, Alibaba and Tencent talks about states actually having direct equity ownership in these companies in the foreseeable future. But I think what can be said with a fair amount of certainty is, given the public outcry over issues such as data breaches at Facebook to Cambridge Analytica and how people's personal information is being treated, there are strong public outcries for greater regulation for the sector, and greater regulation ultimately calls into question, can the sector continue to grow its earnings base at the prolific rate at which it was growing? And if you look at, that's really been the reason that the sector has been able to trade at such a big premium relative to the overall markets over the course of the last couple of years, is because their growth has significantly outperformed that of the overall market, even in strong earnings growth markets like 2017, as this graph shows. But what's been happening in 2018, earnings growth so far from the remaining part of the market outside of tech have actually been stronger than those of tech, and the market is starting to wonder whether this is an ominous sign of what's to come. And I think that's that's why we've seen tech companies derating to the extent that we have this year. I think that this, unlike
I think in a sector like this, companies tend to run ahead of the regulator. Regulators always work behind the curve, and I think the concern, even though driven by regulation, is really less about whether regulation is going to dampen the ability of these companies to earn, but rather more about, given the high level of earnings and the fact that these companies seem to be generating returns in excess of what the economy is growing at, can it continue in the same vein that it has? And there's no doubt that many of the companies in the sector do trade at very lofty premiums.
So if we had to move on, to basically the title of this presentation and what's been dominating a lot of market participants' minds so far this quarter has been, the threat of trade wars. So, I think there's a lot of nervousness about this. I think this graph shows why exactly this trade war is a very real reality. And I think that, Trump is basically talking to his constituency. Basically, less than 40% of the US population believe that globalization is a good idea. I mean, that's a staggering number. If you consider that only something like 5% of the total cost of imports into the US are accounted for through federal customs, it's astounding to think that actually 40% or 60% rather of the US population is actually against globalization. So this is exactly the heartland to which Trump is talking through his rhetoric. He seems to be talking very, very aggressively about the trade tariffs that the US is going to be able to implement. Whether it's going to be able to deliver on that or not is altogether very, very questionable.
Yeah, and I think that is the key, because with politicians, a lot of it is about speak and appealing to your constituents and to your voters. The ability to actually implement is then really quite quite far removed from just the talk around it. So, you know, there has been a lot of heightened market risk based on talk around trade wars, and we've seen it getting a lot of media attention, and it's typically been very negative. And I think the general market consensus is that trade wars would be negative for the overall economy, global economy, not just specifically the US and China, and that has created concerns around global growth. But you know, in reality, I think there is a lot that goes on behind the scenes that we're not privy to. A lot gets said and done. You know, we saw off the back of talk about trade wars and increased tariffs that suddenly there was a lot more concession by North Korea in terms of being amenable to looking at disarmament and talking about nuclear weapons. So, you know, a lot of the politicking sometimes leading to outcomes in different sectors. But the reality is that that China continues to buy US debt, and this is what the following graph shows, is that, you know, China is a major holder of US treasuries. So, you know, 1.2 trillion rands worth of US bonds are owned by China. And, you know, a trade war could put, you know, the US financial system at risk if it escalates to the extent that China decides that, you know, they want to start offloading all of these holdings into the market. It's going to have a significant impact on that US Treasury market. So, you know, a lot is being made about the talk around what's being said, that, you know, there are fears about the impact that it will have on economic growth and the global economy, especially for countries that are really just starting to be beneficiaries of increased growth. But whether anything actually comes to fruition is going to have to remain to be seen, and I think, you know, a lot just needs to wash through in terms of noise that's being created in the market, as opposed to any real risk to the fundamentals. And, you know, when we look at the market as a whole, and the stocks that have recovered, I mean, we've seen particularly strong performance from growth stocks, but there is still a segment of the market that continues to appear attractive, given that, you know, it hasn't had the tailwinds of being seen as bond proxies or being delivered or delivering high dividend payers, and as a result, you know, if this graph breaks across the different sectors, that, you know, there really is quite a few. There really are quite a few sectors of the market that still haven't delivered performance, and that what we've seen is more disappointment and a selling off of those sectors that have run incredibly hard and been incredibly strong for so long. So, you know, while the market performance has been disappointing, and we've seen, you know, negative months from the market, the reality is that there has been a little bit of a re-rating in the expensive stocks, and those stocks that have yet to come through and deliver strong performance have really held up quite well into the sell-off. So, you know, we remain optimistic about the ability of offshore stocks to still be able to deliver good returns to client portfolios. We're not down weighting our offshore exposure at this point in time. A large part of it has been hurt by the strong rand performance, but we still feel there are very attractive opportunities offshore that can still be accessed, and that, you know, a lot of the value stocks will still come through and deliver good earnings. That's really the sum total of the presentation that we have today. So to wrap things up, we are aware that it's been an awful quarter to start the year, that it doesn't really align to improving sentiment in South Africa specifically, but really that, you know, growth remains on its trajectory. It remains robust, that there is an increase in volatility driven by heightened geopolitical tension, but that if one looks through the noise, that, you know, we still are finding attractive investment opportunities both locally and offshore. If anybody would like to ask questions, please feel free to do so. You can type your questions in, and we'll be able to see them and respond to those. Otherwise, if there are no questions, thank you very much to everybody for joining us. Okay, sorry, we have one question on what is our view on global listed property. Global listed property has been one area where we've had capital allocated for quite a while now. It's been a source of underperformance in our portfolios. However, we still feel that this is an area that remains attractive, that increased global growth has been positive for the sector. There has been a lot written and spoken about in terms of retail, that, you know, the retail sector is under a lot of strain globally because of online. But I think, you know, these are isolated occurrences. It's not a global trend, and that, you know, global property has sold off around, you know, the online revolution, as well as, you know, concerns around Brexit. But, you know, any of this has really been overdone. The companies still trade at very attractive valuations, that their earnings are still strong, occupancies are good, rental escalations are good, and that, you know, we are happy with our position in global listed property, and we still feel that it has the ability to deliver attractive returns.
Great. If that's it, I think we'll wrap up. Thank you so much for dialing in. If we didn't manage to answer any of your questions, just maybe pop us a mail, or if anybody wants a copy of the presentation, we're happy to share that as well. So thank you very much for dialing in, and if there's anything else, get in touch with us.
Great. Thank you very much.